Okay, Nandika has also joined us. I think we will get on, we will start the webinar, everybody. So, good morning and welcome to all those who are joining us live um, to this webinar on financial restructuring put together by the Asia Securities Investment Bank and the Ceylon Chamber of Commerce. We plan this webinar from now will go on till about 12:30. We'd love to have wide participation in terms of questions, in terms of even comments, so as long as they're brief, so that we can accommodate as many ideas and try to create a rich discussion about the challenges facing businesses. I mean, there is this witticism about financial crises and recessions that suggests that businesses get into trouble not going into a recession, but really when they're trying to come out of the recession, when an economy is coming out of recession. And potentially one of the reasons for that could be that businesses don't think deeply enough about restructuring their balance sheets or financial restructuring in general. And to discuss this, we have a great panel here today. However, before I get to introducing the panel, can I suggest a few webinar ground rules for those on the call? This is a regular Teams meeting we are in. So unless you are a panelist, I would kindly request you to keep your microphones on mute and also your camera switched on. To the panelists, I mean, you have the option of putting your microphones on and off as necessary. However, once we are through with the first presentation, perhaps I would urge you to put the cameras on so that everybody can see us and can relate to us better. Right. So those are the two basic requests from the organizers. Please keep your microphones off and your cameras off too. Right. So we've got a great panel here today to discuss financial restructuring. And if I can briefly introduce them, and I'm sure they are well known in the business circles of Sri Lanka. To start with, we have Murali Prakash. Murali is the Chief Executive and Group Managing Director of Ambion Capital. Next, we have Nandika Buddhipala. Nandika Buddhipala is the Chief Financial Officer of Commercial Bank. We have Nayamal Gunawardena. Nayamal is a founding partner of Nitya Partners. And last but not least, we have Sharani Kulasinghe. Sharani is co-head of Asia Securities Investment Bank and who are one of the co-organizers of this webinar. So welcome to all of them, and also welcome to the dozens of you who have already joined us, and we're sure many more will. And the structure of this webinar will briefly be that Sharani will start off the conversation by presenting some findings from a recent survey done by Asia Securities Investment Banking amongst businesses in Sri Lanka about how they're shaping up in the post-COVID business landscape. Followed by that, we'll have each of the panelists perhaps taking 3 minutes to set out some talking points for the rest of the conversation, right? And I urge everybody online also to start putting in their questions. You can do so by clicking on the conversation icon or the chat icon. Put your questions there. We can all see it, and we'll try to take as all that is relevant for today's discussion. We'll take all those questions in. So we plan to keep this very fluid. We want a vibrant discussion about challenges and potentially ideas about how businesses can approach restructuring in this in a climate that hasn't spared anybody. I think has potentially negatively impacted cash flow, revenue, and the critical factors that make a business successful usually have been adversely impacted. So it would be interesting if we can make sure that our audience here can take very tangible insights and recommend ideas out of this session. So to start with, Sharani, we'll go to you and hear from you what the survey has found. Over to you, Sharon.
Thanks very much, Shamindra. Let me just put the presentation up. I hope it's everyone can see it. Yeah. All right, great. So good morning, everyone, and thanks so much for joining us today. As Shamindra noted, we wanted to share with you some of the insights from a survey that we recently conducted. The goal of the survey was really to get a sense of how businesses were impacted by the pandemic and the associated lockdown, understand how they responded to it, with a view to getting a sense of what are the current challenges that these businesses are facing. So we conducted this survey over the last 2 weeks. It was kind of broadly representative. About 40% of the respondents were from the manufacturing sector, about 40% were from services, and again, they're very well represented across retail, healthcare, logistics, IT. And around 50% of the respondents had more than 100 employees, with the remaining 50% kind of being evenly distributed across sort of the smaller brackets. So again, we felt it was representative and perhaps indicative of some of the challenges and the kind of ways that the businesses have been navigating the pandemic and lockdown over the last couple of months. So to get right into it, what we're seeing is that businesses really experience two types of challenges. I mean, there were the very clear operational challenges. So with the lockdowns, with the dramatic change in sort of market structures, 74% of businesses saw a decline in sales, declines in revenues. And then on the other category, they really did face supply chain issues. Businesses had issues procuring their supplies, and they had issues with logistics. So they're 33% on the procurement and 23% on logistics. The other bucket of challenges that businesses faced were around financing, as you would expect. So around 35% of businesses are really struggling with liquidity at the moment, and 25% of them are actually having difficulty obtaining the funding that they need to operate. So we also looked at how businesses responded to this on the operational side, first of all. So it's sort of a remarkably coherent response on the operational side across all businesses. So you see around 80% of businesses really focusing on collections. So that seems quite consistent across sectors. And then there was, of course, a focus, as we have all heard, in terms of cost cutting. So 72% are looking at general cost cutting across the board, and around 45-50% actually focused on reducing staff costs. Going to the financial side, what we saw is that businesses were quite proactive in trying to find ways to manage their liquidity. So they applied for debt moratoriums, they deferred credit repayments, they utilized their existing facilities, and some businesses even applied for new credit. But what we also saw is that despite taking these proactive measures, many of the funding requirements for a lot of businesses went unfulfilled. So really only 30% of businesses were able to get more than 75% of their funding requirement. 70% were not able to, so 20-odd% actually had their applications declined, and 50% of businesses ended up getting less than 75% of their requirements. So from this, you can see that there really is a need to figure out the funding requirements for many businesses. Consequently, as you would expect, businesses are facing cash flow issues. One thing that we found interesting, we compared the results of the survey done by the Employers Federation Council in April-May with the survey that we did in August. Now, of course, it's important to note that these surveys are not directly comparable. They were different surveys, different samples, but it was interesting to us that they actually revealed very similar results. So the Employers Federation survey, which was conducted in April-May, which was really in the first part of lockdown, 54% of firms said that they had cash flows for less than 3 months. Then 3-4 months later, when we conducted our survey, that number was kind of the same. So just 50% of businesses, again, had cash flows for less than 3 months, suggesting that the cash flow pressures that businesses experienced in April, May have not really been resolved at this time. And then what we found, again, quite important to note, that as a result, many businesses are facing uncertainty about servicing their debt post-moratorium. So of the survey we conducted, around 40% of businesses said that they are either unable to or they're not certain about whether they can fulfill their post-moratorium debt service obligations. So around 7% actually were very clear and said they really are certain that they are not able to service these obligations. And around 32% said that they're not sure if they are. So that again points to the financial stress that many firms are still experiencing. And that is why we felt it was really important to have to have kind of an educational webinar on what financial restructuring is, because financial restructuring is what would enable some of these firms to address their debt service challenges. So the idea of financial restructuring is to figure out to restructure the company's balance sheet to be able to create a sustainable firm going forward, and also to ideally increase the value for all stakeholders, that being debt holders, shareholders, suppliers, and various other stakeholders as well. So there are three components of this, and I won't go into too much detail in this, and I'm sure we'll address all of these things in detail going forward in the panel discussion. But there are three components that we kind of roughly see as part of the restructuring effort. The first part is really, how do you figure out efficient use of the existing resources you have? Are there ways that you can make your cash flows more efficient, your debt more manageable? How can you make use of your existing resources? The second part is, once you've done that, how can you reorganize or restructure your existing finance and your existing obligations to ensure a more sustainable firm? And finally, once you have these sort of locked up, the third part is, can you secure additional financing to support the growth aspirations of your firm? So these are the three components that we think about when we look at financial restructuring, and they all work together. They're very interlinked. And as I said before, the real goal of embarking on this exercise is to help a firm that is having financing pressure, cash flow pressure, to first get to a situation that they can survive over the medium term, and also to be able to actually kickstart their growth prospects over the longer term. So with that, that kind of finishes my presentation. So let me hand it over to Chamindra.
Thanks, Sharini. Murali, can I ask you first to start? Okay, so we are having Murali, are you online?
Hello. Yes, I'm on.
Okay, before you start, can I ask everybody else on the call to mute their microphones, please? We are having some feedback from out there. Okay, that seems sorted. Right. Murali, the stage is yours. Would you mind switching on your camera?
I have switched on, Shamindra.
Okay.
You can see me.
All right, great.
Okay, great. Thank you, and happy to be part of this webinar today. So I just thought, in the opening address, I'll just give some perspective to this whole thing that we are trying to discuss today from a business perspective. There are many financial wizards here today to answer more in-depth financial questions and legal questions, I believe. So essentially, to me, restructuring means two core reasons that comes to one's mind. One is to be more profitable, and the other one is to organize your entity to be better today as well as tomorrow. So financial restructuring, if you take, in essence, refers to reorganizing your assets and liabilities by and large, how that whole thing works for you to make money. So whether it's simply a financial exercise alone, well, my perception is that it has to be a slightly bigger picture. I think Sharni touched on it in her last slide. That's what will take you through into the future. But Having said that, there is also a need to ensure that, in the short term and medium term, you restructure in a manner where, your internal efficiencies are geared towards bringing up that required cash flows or whatever, to go through your business. So essentially two parts that we are talking about. One is how do you galvanize your internal resources to make more efficiencies, and secondly, looking at the external factor of your business and as to how you can make it future proof. And also this question, a lot of people wait for your businesses to be restructured only when actually becomes an acute problem. But that need not be. Say, you have to start looking at your business and for vital signs. Say, for an example, if your growth is stagnating or you have experienced cash flow issues, over dependence on debt, maybe customers are shifting, all these things, and also against the current pandemic and, speed of technology, all that, you need to take cognizance of the fact whether your business needs a relook at. So, going beyond the crude financials. So restructuring for me, from an internal point of view, it is rearranging your assets and liabilities for better growth. And from an external point of view, to build that story and realign your business. That is what, I heard Sharni somewhere saying about confidence of lenders. In my experience, when you go to banks or lenders or shareholders, anybody asking for more money, one of the first things they would look at is your story as to how good you are today as well as tomorrow. So you need to both have this internal restructuring for efficiencies, which we can talk later as to how you can bring those things, and external oriented restructuring, if I may put it that way, a holistic business cycle application to be more efficient. So that's broadly how I thought I'll start the whole thing, and I'll leave you with that thought until I come back for further discussions. Shamindra?
All right. Thank you, Murali, for that. Nandika, being the banker, I think it naturally follows. Can I ask you to present your opening thoughts?
Thanks, Shamitra. Thanks very much for inviting me for this occasion. Shamitra, I think the most of the basic things Sharini and Murali has really touched on. Specifically, I think one of the most important factors is going to be this restructuring idea. So-called restructuring cannot be kind of ad hoc thing. Each and every, it should be part of your day-to-day kind of thinking as well. Specifically, when we look at the cash flows which are coming through, there again, the assets and liabilities where it is finally getting connected to. Those are getting connected finally through your operational kind of activities getting into your cash flows. So it is paramount of importance for us to keep in touch with the situation. There again, the most important thing is when the signals, those signals can be without deterioration of your top line, or otherwise it can be maybe you're running into certain kind of other decisions where you take the decision. Sometimes, unfortunately or fortunately, what we have seen is when there's a good buy, you run for it. So you need to take risks. There is no argument about it. Yes, otherwise there is no way for you to expand your businesses. But there again, most important thing is once you run for a good buy, then how it is going to get integrated into your operations. What kind of return that you are going to look at. Then again, sometimes that particular good buy can be maybe some kind of a property at bargain price. But there again, if it is at bargain price, what kind of cash it's going to get generated? If you use your cash for that, how you are going to have your the medium and the long run. Those kind of issues are kind of thing that you need to always keep in mind, as well as you need to revisit specifically your assumptions of your business and the business model. Unless otherwise you don't do it, maybe each and every signal. Now the pandemic is of course completely different, unexpected kind of situation, where suddenly something came externally where you have no control over. But there again, if you have some kind of rather than very static kind of thinking, like say for example, most of the customers still when we look at it, some of them they were able to get funding, some of them they were unable to get the funding. But there again, even Sharini's survey shows that the quite big number of people still living in hope. So for that, there again, you need to have maybe under uncertain kind of situation where the information is not going to come through the way that we want. that kind of uncertainty, it's specifically where it is required for us to have maybe different kind of scenarios as well in place. If you cannot really run into one scenario, then you need to fall back to something else. Then that kind of agility, it is really required within your organization as well. If you have some kind of flexible way of doing things, then probably you might be able to adjust it. The other conundrum or other kind of connotation when it comes to any kind of restructure, Samendra, we are very much about to it. What we normally do, go as it is. We try our level best to do our operations and cost cutting, and then there again try to get the revenue in, specifically coming into the cost cutting as well. But there again, if we are not going to look at restructure meaningfully as morally very well articulated, because your business model, how we are going to change it, how we are going to adapt it according to the situation, then there again, with that, the balance sheet, how we are going to look at it, whether we need some more capital, how we are going to get that amount of capital, because you cannot be overgeared all the time. Now, sometimes before the pandemic also, we have seen some of the kind of the customers may be running into some kind of above the board kind of gearing. When it comes to bankers, always the banker also would like to share the risk with you. That risk sharing, there again, your side, on the customer side also should be there. You need to have the comfort. You need to have even the comfort in the management. I think that kind of flexibility, that kind of thinking, and there again, rather than ad hoc kind of approach to restructuring or otherwise negative connotation to the restructuring, these are the things that we observe from the banking side. I leave it at that, and then there again we can run into certain other discussions.
Thank you, Nandika. Namal, can I ask you to go next, please?
Good morning, everybody. Yes, I think what was interesting about what Sharini and both Nandika and also Murali indicated was that primarily there needs to be operational restructuring, which I think needs to take foremost importance in the whole restructuring process. And to that extent, I think legally, there are very few implications or add-ons which come on at that stage. I think one of the things which I can possibly think of is obviously staffing may need to be realigned in order to effect operational efficiency. So therefore, there would be some legal impact of, let's say, laying off staff or relocating staff and things like that. But I think the main focus of something which is legal would be that at the stage of reorganizing of your existing financing, yes, I think that is one area where there can be a lot more proactive actions taken by corporates within the framework of the law for the purpose of getting a much more desirable result. Because what happens is that sort of process is not followed for various reasons, one of which is obviously secured creditors versus unsecured creditors, bank creditors versus general creditors, and various competing interests coming into play, and as a result of which the full scope of restructuring of the financing affairs of companies does not take place in an appropriate manner. Then obviously the third stage is obtaining fresh financing. Yes, once again, within the scope of restructuring which is already in place, if fresh financing has to come in, then once again, there could be legal implications of new creditors versus old creditors and how their various rights and entitlements are going to get structured. So I think the emphasis on restructuring is on the basis that operational efficiencies would need to be effected. And to that effect, to that extent, I think legal has a more limited scope, then would be generally applicable with regard to a pure financial restructuring. Yeah.
Thank you, Noyamal. Can I post a question to the panel, and I'll possibly ask Murali to take this one first, right? Murali, I mean, you invest in businesses, and obviously the conditions now for any investor are quite daunting when you're looking at a new business, right? In this climate, as somebody who's an investor, what are the red lights do you think a business must consider if it must, then, if it is to take that decision to not just operationally restructure but financially restructure? Are there some numbers about gearing, about any other matters that you think are red lights?
Gearing, Shamindra, is something that world over people, investors look at. But there are norms that people set on these things are arguable in many instances. For an example, say if it is software related businesses, they say your gearing ideally should be around 2, not more than that. But for manufacturing, I'm sure there are financial reasons here. They might agree, disagree with me. But for manufacturing, they say, even up to 4 or 5 times is okay. I know banks go much higher. So it kind of is also in relation to the business and the industry that you are in. So probably that is one area that you look at. But for me as a business person, I think more I look at, actually, I tend to look at more the external perspective of this entire acquisition process as to how that is going to add value to your business. It is not that, you are going to have a business acquisition to meet your demands for today or within the next 1 year just alone, but it is the journey which you're trying to augment. So I kind of look at, most of the time we look at, or when I say I, the group, or, the investors that we are involved with, we look at as to how we could augment that process and as to how that is going to augment your core competencies and how it is going to relate to your business into the future. For an example, a couple of years back, we went into technology and acquired technology. It is all to do with as to how that is going to augment each one of our businesses, be it manufacturing, financial services, real estate, or whatever, and on its own as to how that technology business can move into the next level. So yes, internally, if you ask me, we look at some of the basic parameters in terms of your affordability to acquire. So whether, gearing is one, how much can you bring in terms of debt? If you can't bring in debt, then what else can you do to structure that deal? There are many ways to structure a deal. I'm sure people like Nirmal will be able to spell out in detail. So you need not, in today's context, necessarily put down all the money today. You can have staggered acquisitions. You can also bring in equity, a part of it. Quasi debt. Many quasi equity, many things that you can do. So internally, while looking at that, if externally, if the potential is they are greater, then we try to align. Obviously, any company, any business will have a maximum amount that you can chew up to. So that is something internally you will have to bear in mind against your cash flows, against the appetite of your investors, how much they are going to put in, and how much you can bring in through your balance sheets as well.
Can I ask Sharini to also come in, and after that, can I ask Nandika to comment? If in your experience going out there talking to businesses, and Sharini, you presented us those findings from a survey, and if businesses have had to increase their debt in a time when their revenue is also declining, have you noticed that in a legal sense that businesses could potentially, many otherwise healthy businesses or marginally healthy businesses could slip into a place where they have a serious loss of capital, legally a serious loss of capital?
Thanks, Chaminder. I mean, it's been something that we've actually observed over the last couple of years, that you've seen a number of businesses that have invested in their operations, invested assuming sort of a growing market, taken on debt for that. And what we've seen is they have not been able to capture that. As a result, you have businesses that have invested or have a certain capital structure for a market that does not exist. And that was really accentuated through the pandemic when the market sizes, everything really changed. So it kind of further accentuated a trend we had been seeing for the last couple of years. So we have been seeing businesses with a significant deterioration in capital, and I think that was really numerically or quantitatively seen through the survey we conducted. But what I wanted to note also is that that in itself is not a deterrent for the company to raise new capital. At the same time that we've been seeing these trends, and as you noted before, it's sort of a challenging environment for investors. Nonetheless, we have seen a number of investors come to us and express interest in acquiring either minority stakes or controlling stakes in a number of businesses. So even at this time, I would say there remains investor interest. To Murali's point, it really is about how you structure the deal and what is that core investment story that you present. Are you able to present a strong investment story? Are you able to give the investor a good reason to put their money down and support you during this phase? Can you tell them a story where that they believe that they can really make their returns, or as Murali noted, that there are synergies to their existing businesses? So when you have that story in place, capital structure is a problem to solve. It's not really not a no-go. It's really what you can figure out deal structures, you can figure out restructurings that can enable a company to move forward.
Naima, can I bring you in on this? It is likely that many businesses that are struggling may see that their balance sheets slip into a situation where they are categorized as having a serious capital deficiency or a serious loss of capital. What are the legal implications about trying to restructure a balance sheet when you are in that situation?
Yes, I think this is quite an issue because there is a section 219 in the Companies Act which says that if a company is unable to pay debts in the normal course of business, then in such a case, the company at that stage needs to make a formal decision, the board of directors, as to whether the company should be carried on or whether the company should be liquidated. So therefore, it is one of two paths which needs to be taken. And that section says that if by some chance you decide to go on and the company is eventually liquidated, then in such a case, each of the directors who did not vote in favor of liquidating the company, or in other words, it's not only the people who voted in favor of going on, but even the people who did not or who abstained from the vote itself could possibly remain liable for the debts of the company, very especially the debts which come on subsequent to that incorrect decision being made. So therefore, in a legal sense, there are very strong implications or very serious implications of you carrying on a company which is unable to pay debts, because you could possibly end up being personally liable if by some chance eventually the company goes down. So this is something which obviously is of concern, very especially in the case of a restructuring. It is obviously necessary at some stage very early in the process to reach agreement with all your creditors, whether it be banks or whether it be unsecured creditors, because if by some chance you don't reach agreement on the process going forward at a very early stage, right, you possibly could have personal implications in carrying on a business which eventually would go down.
Right. Just to clarify, Naima, there. So this implication is both for obviously bank debt and also for unsecured creditors.
Yes, definitely. And I think one of the categories of creditors whose interest must be really looked after is unsecured creditors. That's a forgotten lot. They are not organized like banks. Banks are well organized. They take security for everything which they give. whether it be immobile properties or mobile properties or guarantees from shareholders or whatever it is. But there is a lot of unsecured creditors, very especially persons like suppliers who are totally unsecured. And if the company goes down, actually they stand to suffer the most in these sort of situations. And I think special emphasis and there should be an increased amount of protection which is available to that category of creditor.
Right, Nandika, can I bring you in? Again on this serious loss of capital situation where a company finds itself that its losses have really wiped out its equity in its balance sheet, and also taking from the point that Sharini made, over the last couple of years, companies in the expectation of higher economic growth had been investing capital, and now find themselves in a situation there where they're fairly highly leveraged and overextended, right? Um, not necessarily commenting about commercial banks portfolio, but what are you seeing in general in the industry about balance sheet health currently, and how do you think banks are approaching this?
Yeah, it's a fairly interesting question, Shamindra. I think rather than concentrating on the bank which I represent, maybe overall, from the bank's perspective, I think it is, as Nyomal also mentioned very correctly, some of these we need to look at a bit early stages of the problem. There again, when it comes to banks, sometimes there is a fair amount of understanding of the culture of the organization as well. There's the management style, and sometimes specifically not per se banks, but the rating agencies also go into details of the governance structure, even sometimes the banks as well, very specifically. And there again, when it comes to certain situations, then the restructuring is going to take place. I mean, it's very important with whom that you are going to yourself is going to get restructured. I think the Nyomal also kind of very well articulated about it, how when even Sharini as well as Murali, where how this particular with whom that you are going to raise the capital. Specifically, you cannot go forever gearing it and kind of getting it only through the banking system. Quite obviously, you cannot have. But the gearing may be organization to organization. There again, maybe industry to industry is fairly different. It's a tech-heavy kind of thing, and there again, when we are running into very limited, I mean, very short time of technology life cycle, then there is a fair amount of gearing which is taking place. So the banking side, we have this particular understanding. Various industries will run into kind of different gearing the structures, and there again, the important thing is when we are running out of capital, then there again, the important restructuring is maybe going to be your decision rather than bankers kind of coming and intervening it. The mostly it is obviously you need to take as the entrepreneur yourself, whether you have certain unco or otherwise maybe whether the part of your business or maybe part of your portfolio is not really performing well, then you need to do certain kind of restructuring in that part as well. The one side of it's going to be maybe handing it over to somebody who can run it well, or otherwise restructure that particular part, or otherwise you do certain maybe run into other markets where you can perform. You need to really look at your portfolio very, very carefully if it is a bit diversified as well. Then the other important element is going to be, Shamendra, how we are going to bring in new capital, with whom we are going to flirt with, what kind of person with whom we are going to flirt with, and whether the banks and the community is going to accept those kind of changes, whether that will completely change your business model because the new person who's going to come in can bring in completely different culture. Then you might be having certain covenants with the bank. Even sometimes if there is a kind of change in your management or change in your board or other kind of things, you might have to renegotiate. I think Yamal very well articulated it. You need to really rush into this much before the problem arises. But unfortunate thing with the pandemic is nothing has been expected to take place like this. So that situation is really, we are going through this particular learning curve throughout the world. We'll take certain lessons out of it. And as we go, we'll run into certain other decisions. But when it comes to you are really struggling, really loss of your the capital running out, then what you need to do, what kind of collaboration that we are going to make, always your story, rather than before you take the decision, this particular consensus of all the stakeholders. As Neomal said, not only the debtors and others, or maybe not only the stakeholders, the shareholders per se, but they are again the lending agencies, because by and large, sometimes your debt can be much higher than your capital even sometimes, but the retained earnings can come into the middle. But this particular conversation with the banks before you run into decisions, and not really divulging all the internal things, but at least to make some kind of consensus with the banks is going to be fairly important, Chandra.
Right. Let me ask you to simplify this in a way that maybe gives us an understanding of your perspective, right? So I'll give you a range of 1 to 10, okay? And each of you have a unique vantage point, right? So you have a 1 to 10 range. In this range, we are talking about not operational restructuring. We are talking about your experience of others who are restructuring, and particularly financial restructuring, so balance sheet restructuring, right? Not of your own companies, but you come across companies, right? Nandika, for instance, you would come across many balance sheets, right? How many of those companies, in a range of 1 to 10, 10 being all of them, 1 being very few of them, do you think are doing enough on financial restructuring? Nandika, can I ask you to go first?
Yeah,
in your experience, this is your experience.
Yeah, I think they sometimes, rather than a given framework, I'm fairly open about it, Shamdra, and fairly bold about it, rather than trying to kind of secure anybody's interest. I think the proactiveness is not pretty much there. You look at a lot of other things first. First, you try to restructure that with the bank. That is good, I think. Beforehand, you try to kind of define it and look at the realistic cash flows and have some kind of conversation. Extremely good thing to do. But there again, when it comes to the other side of it, you try to the operational efficiency is paramount of importance, but you really try to do certain other restructuring, specifically cut down of your expenses and look at certain other things. Finally, the most of the instances, the final thing is you look at your financial restructuring. That is fairly obvious, Shamindra, when you look at the statistics. Maybe 1995, when we go back to that level, how many IPOs we have seen. I'm not going to say this restructuring is only IPO. But there again, when we look at the M&A, except for, I think Mural is there, and there are the other people who have been very proactive in coming and doing those kind of things. But how many of them? Very handful. When it comes to SME and the other parts, how many of them are looking at these kind of options? Whether those kind of options are available or not is another issue, and they are understanding about those options is one of the issues. But there again, my point of view is when you have these kind of issues, the financial market itself need to look at a wide gamut of spectrum. It can be the banking, it can be other parts of the financial, the markets. You need to have this particular collaboration that will complement each other. Specifically, at the time, if you take statistics throughout the world, when there is huge amount of IPOs, when there is huge amount of what you call M&As, at the time the banks are thriving as well. So it is not really contradictory to each other. So
in your experience, Nandika, do you feel enough companies have come to the point of realizing, okay, we need to restructure our balance sheet, and are they doing it? Half of what you're encountering, half of the companies you encounter, are they doing it, or is it less than half?
It's very difficult question to answer. Very the straight Shamindra by statistics like that. But I think it's better if we have much more understanding of the restructuring of the finance side, much more than what we have at the moment. Shall I put it in that
Okay,
sense?
that's fair enough. Murali, can I bring you in? You will, for deal making purposes, only be looking at a few transactions at any given time. But in your broad experience, do you feel, from your vantage point, that companies are addressing financial restructuring, balance sheet restructuring right now?
Let me first give you a direct answer. I might be totally off, but in my experience, Shamindra, I have over the last 35 years, I probably would have handled about 40 to 50 industry-centered businesses directly. So my experience says, sadly, it is probably at somewhere around 4, if I may put it that way.
Right.
If you ask where my businesses are currently, I would still like to put it at about 6 or 7 at best, because there is always room for improvement. Let me qualify my statement with a couple of things that I have seen during my working career. Say, for an example, Nandika, I think, hit the nail on the head. The first thing most of us try to do is to borrow more. We just run to the bank. We have a problem. Give us more money. Now, little realizing your balance sheet probably has a whole lot of money that is tied up in unwanted areas. Your financial restructuring starts at home. How efficiently have you managed your balance sheet, your current assets, your liabilities? How exactly have you managed those? Your working capital cycle, for an example. I have seen huge inefficiencies in working capital management, overbuying, wrong price, storage issues, and mismatches between supply chain, demand issues. You buy the product that is not needed, and at any given time 40 to 50% of your inventory is idle, or it is not making the right amount of money that it should make. So this is one area. Then I have also seen huge mismatches in what I call the timing. See, in any business, from the start to finish until the customer consumes, there is a timeline. So you buy the product, buy the raw material or whatever, you provide the service and collect the money. Now, the more this time is, the more your cash is tied up. You take manufacturing organization, including mine and many others, you would find it takes 30, 40, 50 days for a product to be turned out. That means your cash is tied up for 50 days. If you can shorten it to 30 days, you have your cash deployed. So whether we have done enough of that kind of internal engineering, financial engineering, if I may put it that way, in terms of working capital management, in terms of timing mismatches. And another big thing I have seen is what I call the profit leaks. All over the company, I can name 10 different areas where your profit leaks, and thereby what you have to, I mean, what is possible to be made into a profitable venture sometimes becomes a negative venture, or for that matter, where you could have made 10 rupees, you're only making 5 rupees. So therefore, your efficiency to that extent is not the best. So that's what prompted me to say, if I'm to give a score, it's about 4. And finally, let me also sum up with this. Most businesses wait for an emergency to hit to restructure. Now, that's a wrong way of restructuring. Restructuring should be something like, I think Sharani also touched on it, something that you should be doing on a daily basis, annual basis, to take stock of your business. Where is it heading? How can we build efficiencies? So I think you should first look at your inner financial engineering to bring the financial restructure with aligned to your core business activities, and then simultaneously maybe you can look at other possible areas of bringing new funds and so on.
Shalini, can I bring you in here? For those joining us, can I ask you to switch off your microphones and your cameras, please? Please switch off your microphones and cameras. So I think there's somebody on the call whose camera is on. Can I ask you to switch it off, please? Shalini, I'll bring you in, right? I think your video will override this. We are in where we are. This is post-COVID, or we're just dealing with the impacts of a huge crisis that hit businesses in general, right? in your experience, do you feel, do you see that businesses seem to be getting as far as financial restructuring now, right? Yes, they should have done it ideally in the past, but let's leave that because we are in this crisis. What's your experience on this?
Yeah, I think I would agree with Murali. I feel if I was to give it a number, I think it's somehow in the 3 to 4 range, and for a couple of reasons. I think one, of course, as you said, I think a lot of businesses are not cognizant of it until it is quite late. So, and not to harp on this point, but just to talk about it from a business owner's perspective, the longer you wait, what ends up happening is you see deterioration in the value of your company. So what we often see is that businesses will come to us when they're facing these working capital constraints for quite some time. What that means is they haven't been able to achieve their full potential in the market for a number of months. And consequently, you've seen a deterioration in value. So at that point, you're already starting from a slightly like back foot. The other reason I think more could be done around this is what I've seen is a lot of businesses we speak to do not take or could take more of a holistic view of what it means to restructure. A lot of the conversations we have are specifically around, a few loans or something like that. But I think Murali highlighted very well that you have to take a very comprehensive view to your balance sheet as well as to how you're making money. So on the balance sheet, there are a couple of different things you could look at. It's like one, of course, how can you restructure your liability side, and that a comprehensive view of your liabilities, both in terms of your bank debt and your unsecured creditors. What can you do there? And then importantly, I think to look at is on the asset side, like what efficiencies can you get from redeploying capital on your balance sheet? Are there, for example, properties that are not well utilized? Can you dispose of them and perhaps bring more liquidity into the company? Are there subsidiaries that maybe you don't need right now that you can divest? Are there other sources of cash on your balance sheet that can be released? And also then looking at how you could do that in a creative and structured way. For example, if you have some, a receivable that maybe it's long dated, but it's from a good company, can you look at securitizing that? So what I mean to say is that restructuring should be looked at in a holistic way across all parts of the balance sheet. And then, of course, as Murali said, there's a whole bunch of things that can be done on the operational side that I won't go into. But yeah, just to say that I think that it's important to take a holistic view of this.
All right, Naima, can I bring you in on this? As companies go about negotiating with creditors, not necessarily limited to banks, but creditors in general, both secured and unsecured, are there provisions in the law that can potentially aid those negotiations in the climate we are in? In the extremely stressed sort of business climate that companies find themselves in, are there provisions that can be useful that can?
Yes, definitely. There are specific provisions in the law, very especially there is a section on compromise with creditors, which has hardly been used. These are all provisions in the Companies Act. Then there is provisions for administration, which has hardly been used. Then even the term scheme of arrangement is also a provision which is hardly used, even though those specific provisions are contained in the Act itself. So by and large, what it means is you need to deal with your creditors at large, and then you need to reach agreement with them. And some of those provisions require you to get the consent of a majority in number, but maybe 75% in value of the creditors may need to agree to the proposal, in which case maybe the others would be compelled to go along with it. There are certain other provisions which go in the reverse. That is, you may need 75% in number, but maybe only a majority in value. So if those sort of approvals are obtained by the creditors, then in such a case, you may have the ability to be able to reach agreement with them, which would bind the other creditors as well. So these are provisions which are already contained in the Companies Act, which we have not seen being used at all. And I think this is the opportune time for that to be done, because there is a formal process which is available, and it's only by going through a formal process that you'll be able to reach agreement with the large majority of, very especially every company has several banks, maybe 5 6 banks with whom you are dealing. It's always difficult even to reach agreement with only the banks, because some of them are secured, some of them are unsecured, some of them think that they have better security than others, and for reasons like that. But if you go through a formal process, I think everybody would be forced to come into the process. And even if you're a secured creditor, you would understand that maybe enforcement of security won't be easy in these circumstances, because you might not be able to get a buyer for those properties in today's depressed market. So that sort of process, I think, is important, and I think should be utilized fully in today's context.
So just to be sure, this is a process that you can apply both for your bank debt and also for your unsecured creditors.
That's correct.
Right. And if a company is currently now interested, or this comment has piqued their interest, how do they get about this, Naima?
No, I think you need, once again, as Shalini said, you need a holistic view of how the restructuring is going to take place. So therefore, obviously, either somebody within the company or some external consultant has to work out that entire process. Legally is only just a component of it.
Right.
So eventually, there is something which needs to be done currently in respective of current debt, and also maybe new money is required. So therefore, that whole proposal would need to also accommodate new money, either being given by the current suppliers or banks themselves, or maybe some outsider coming in. But to just answer your initial question, Shamindra, once again, with regard to the timeliness of restructuring, my number is 4. And
Right.
I don't have the insights with both Murali and Sharini have with regard to the internal workings of companies. But my view is that, once again, as I think Buddhika said, Nandi said, what happens is they first think that they can somehow restructure it with the banks. And they just withhold their equity, withhold their own equity, or they don't like a dilution happening in the shareholding. That is the last resort for most entrepreneurs. And by that stage, it is too late, in the sense that the interest has just overtaken you. And at that stage, putting in additional equity becomes almost like a fire sale of equity, which eventually does not happen.
There's also, thanks for that, Nayamal. And there's also a question, I'll try to paraphrase this. It's from Aruna Fernando. Are there regulations to transfer NPLs to private investment managers? I mean, I suppose by what this person means by NPLs is not just in a financial institution context, but if you have a large portion of debt, are there regulations that you can transfer this to this distressed debt to a private firm, a PE buyout kind of like scenario, where then it becomes the responsibility of that PE company, a private equity firm or the buyout firm, to collect this?
There are no specific legal provisions which enable such a thing to be done. But however, in a contractual sense, it can be done. So, for example, if you can reach a contractual arrangement with some other company, that they would take over the beneficial interest of this category of debtors in return for payment of X upfront, then in such a case, that is perfectly valid, in the sense that you will continue to collect whatever you can collect, and you will just hand it over to him in terms of the contractual arrangement. So you don't need a legal framework for that, because there can be a financial instrument which should basically enable such a result to be obtained.
And that can be securitized paper or something like that.
That's correct.
Right. Okay. Here's a very practical sort of challenge that many businesses face. This is not such a great time, even if they were willing to dilute, even if the founders or the majority shareholders were willing to significantly dilute their holdings to raise new capital, because the uncertainty may make it difficult to forecast right? And I think the sort of investor in this panel is Murali. Can I bring you in, right? If a business comes to you, how do you get about that, Murali? How do you get about forecasting what their future cash flows are likely to be before you consider investment? Is the process you would follow in the current climate different to what you would have done, 6 months ago, 8 months ago?
So what probably would happen is if you do a future cash flow based valuation or something like that, obviously you would quite heavily discount against possible unforeseen issues that can crop up to that business into the future in a pandemic like this. So to a large extent, it will depend on the type of industry. Now, for an example, technology industries, even at this point of time, is looking good and they're still doing great. In fact, they're growing better than what they usually do. Some of the retail companies are doing great, some are not. Manufacturing has been struggling, so they are dependent on export markets and so on. So it will largely depend on how we see that particular industry. Probably Sharni can add a lot of value into this question in terms of how they do valuations, but from an investment perspective, I would pick out based on the industry, and then with that understanding as to where we should pitch. So obviously from a technology point of view, if a technology investment is coming up to me, I would look at it more positively, because in general context I know that this is an industry that can thrive even during this kind of a climate. So therefore we might have to build certain safeguards in terms of valuing such a company, and as to how much we would like to put down. So it becomes a very hard-nosed game in terms of valuing techniques that we use, and bringing in all those parameters that we want to do. But let me also tell you something. In any adversity, obviously there are great amount of opportunities that you could pluck in. And I know even now there are many investors who are looking, I think Sharni touched on this as well, looking at possible acquisitions. So there is always that opportunity for acquisitions, opportunity for you to divest if you want, and at the same time to look for buyouts that probably will stand good in the future. It's just like how you want to invest probably in your stock market when chips are down. So if you are cash positive, or if you have the ability and the means to invest, then I think you certainly can look at it very positively. Hope I answered your question.
Shalini, can I? Yes, thanks, Murali. Shalini, can I bring you in? How do you do a valuation, discount future cash flows when there's a lot of uncertainty around those future cash flows in the first place? What are the multiples? How will cash flow in general work? There's a lot of uncertainty. Any experience? Any thoughts on that?
Yeah, I mean, I think an important consideration to note in terms of valuation is that ultimately the value is determined by the value that that company will add to an investor. So there is not like one way to look at it, and each investor will look at it quite differently. And if I'm to kind of break down the universe, there are two major types of investors. So you'll have the financial investors who are purely looking at it from a return perspective. They may be the ones that take minority stakes in a business, put in some fresh equity. In that case, there's a lot more focus on sort of the cash flow projections, on how they can add value to the company. And there what you'll see, I mean, currently we're seeing quite a bit, is that investors are discounting projections quite a bit. They are taking that uncertainty, that risk premium that's just much higher right now. So they're requiring, and that transitions, of course, in the end to a much lower valuation. But you're also seeing what we call strategic investors, and these are investors who are looking to invest because this is the sector that they're already in. So it could be, let's say, a company that's manufacturing some item. They are looking maybe to invest in a complementary item. For them, then the valuation is not determined just by the cash flows of that company. It's determined by how much synergy they can bring to this company as well. So an investor like that may be willing to pay slightly more. And that's what we note is when you're looking for an investor, when you're looking to bring someone on, it's really important to approach the right people, because you need to approach the people where you can add the most value to. and that will really determine, that means you will also be able to get more value from that transaction. So I hope that sort of summarizes a perspective on valuation in this time.
I also have a question for the panel about what you see happening out there, right? From where I am, which may not be as great a vantage point as you have on the economy. Do you see companies actively looking to do deals around securing their businesses, around bringing in new equity potentially, so that they can overcome some of the challenges they're currently facing? Is that happening right now out there? Sharini?
Yeah, so what we're seeing is actually there's quite a bit of investor interest to look at companies. At the moment, we haven't seen as a number of companies look at this part. So we're seeing sort of initial levels of interest, but I think given the scale of investment required and given the financial challenges companies are seeing, we haven't yet seen companies consider this path of raising new capital or raising non-bank capital as actively as you would expect.
Nandika, can I bring you in? And we've seen in survey after survey, including with the data, the findings that Sharini presented a little while ago, that many companies feel, a significant portion of companies feel that when the moratorium ends, which will end, I think, in September, that they will continue to be challenged with servicing their bank debt, right? What are the options for companies facing such challenges? And if we were to become very practical, because if as much as 40% of companies that took the moratorium then say, we will still struggle to service this debt, including, the interest now that they will already owe you, how do you practically get around resolving this challenge, you think, from a general point of view?
Yeah, I think I need to touch it very generally, Shamindra, because day to day, the clarity or the number of the way that information used to come through is going to get improved. Then we'll have a certain amount of known kind of information, known kind of judgments, rather than just hovering around in the dark. I think one of the better thing to look at is with the available information, then you need to kind of project what is going to happen. Maybe with certain options available, which option you are going to take. And there again, the situation can be different each and every day. When we go through this particular passage of time, maybe from last March to today, you would have seen a number of other important factors taking place, specifically interest rates coming down. And maybe on the top of it, unfortunate factor is going to be, Shamindra, economic activities. Maybe there is a bit of lackluster kind of situation there as far as economic activities are concerned. There again, when we look at maybe the sentiment of the people, Sharini, it is going to be important for us to redo time to time this kind of survey and to compare do some kind of comparison. Then we'll find where we are standing at the moment. Because time to time, this is going to be very, very different. Then the important aspect is going to be, of course, yes, after the moratorium. Now, already, the certain sectors, Shamindra, tourism and related ones, it's running into extended up to 31st March the next year. I'm not going to say that every other will have similar kind of situation. It's beyond us to kind of project anything. But there again, the important thing is, if it is so, now, what kind of projection compared to now at the time of moratorium starting point, then we have done certain projections with the customers. Now we are in the maybe towards running closer to the end of the moratorium. Then there again the situation we need to redo it and see. Then only we will come into perspective. Then there again by maybe closer to September, end of September, maybe after another 15-20 days, it is there again better to have some kind of stock taking as well as there again, the issue is going to be when you have so many customers, it's going to be a very much a nightmare for the people who are in the front end dealing the customers to do all those kind of calculations. Where you then only the support from the customer also is going to be fairly important. So even though I'm not going to give you kind of a very solid answer, because we are also going through some kind of a learning curve out of it. But I would say maybe compared to March, at least the sentiment. Now, when the markets are bad, sometimes you can see the people are running for the new kind of activities. Specifically, in a hot market, the price that you can get as an investor in a cold market, definitely there is a differential there. I think Nirmal and the Sharni will know exactly what I'm talking about. Whether those kind of sentiments are getting developed is also going to be important. But as far as bank is concerned, even though there is ambiguity, there is negative connotation just after maybe the September something is going to collapse. There are two things. Maybe the regulators have been also very proactive, where they see the recovery is going to be slow. Then what they have done, they have taken precautions. Other hand, what's going to happen, maybe if they really feel and if they have certain kind of judgment, maybe certain industries going to be a bit out of water, then they will take certain other different actions as well. So then maybe one of the better thing is, maybe after another 15 days, Shara needs to run again, maybe after another 1 month's time. Shara needs to really run this. It's very important to get some kind of dipstick to have where we are. So time to time is going to be very dynamic and fluid, Shamitra.
Right. Thanks for that, Nandika. And maybe I'll pose the next question, starting with you. Right. I'm looking for two ideas. Right. One set of ideas, and let's be very pragmatic about the sort of situation businesses generally find themselves in currently. Their revenue is way lower than it has been in the last 6 months. So obviously they are very likely to be out of cash, struggling with cash flow. What are the ideas you have in terms of policy? What are policy changes that can policy changes can address this challenge, provided a business is willing to restructure financially? What policy changes can be done, are available? Policy ideas would you like to propose, and what radical ideas to businesses would you like to put, besides obviously telling them, okay, you need equity, go find equity? It is for a very big business that's possibly, but for an SME, it's not a easy thing to do in this climate, right? On both those fronts, do you have any ideas?
I think this question is very much relevant to the other the panelists rather than for a bit of a conventional type of banker. But I think they are again to be very bold with you, rather than wearing maybe kind of a conventional banker's hat. I think we need to look at the other like we have line of angels, maybe not very active as well. Then we have maybe line of venture capitals who are not very really active. As far as the bankers are concerned, we are not dealing with our own money, unfortunately. So we need to be very conscious of what we are doing as well. Then there's a capacity where to the extent that you can run into. So the other mechanisms, maybe to what I mentioned, the angels as well as maybe venture capitals, maybe other structures, need to facilitate that and need to encourage those people to also look at some of these, and then again to have some kind of a conversation and to have some kind of the exposure they give for them to get into a kind of discussion and for it to get exposed a lot. Then the policy side, I think maybe certain policies that have been taking place, maybe I'm just running into pretty much the very much broader economic perspective. I think the important thing at the moment is not the putting money into different intermediaries, so including banking, but maybe putting the money into the hands of the people in the bottom of the pyramid. It is difficult because the governments, they do not have unfortunately, the muscle and what we call as the fiscal space. But I think that they might find some of the other ways to put the money in the hands of the people where they can maybe have some kind of increase their consumption or sustain their consumption rather. And then it will have some kind of economic activities taking place which will have supply side reaction. So broadly, maybe those are the kind of things I think might have to look at.
Got it. Can I bring you in, Murali? What are those out of the box ideas that you have as policy recommendations? And what are those out of the box ideas that you may have for a company, which may be an SME, which will find sometimes raising new equity in this climate challenging?
Shamindra, let me start with this radical business ideas that you stated about. I think everything, even for a small and medium industry, one of the first things that probably they should be looking at is renegotiating all existing contracts. But don't get me wrong, when I say renegotiating contracts, it could be financial contracts with lending institutes, bond issuers, stocks, etc., etc. Then external parties such as suppliers and whole lot of other business associates that you have, joint venture agreements, employment contracts, because all these add to that whole cohesive business funnel that you have built over the years. So this is the time for you to relook at every one of them. If it be the rental agreement, lease agreement, to employee agreement, look at everything. You'll be surprised how much you can do in terms of value addition to bring. Then secondly, also you might want to look at some small areas which are possible either to spin off or divest. Say for an example, when I say spin off, you have a SBU that looks a very lucrative small business. If you spin it off as a company, maybe there will be some investor who will come and invest that X million rupees to run that part of the business alone, so that this goes out from your main business. At the same time, it brings in a new cash flow altogether. You can also look at some small non-productive asset and other business divestments as well. Also look for mergers. So probably those 4 ideas for anybody. When I say mergers, it is not for the big boys, right? Anybody can merge. So there'll be many who are distressed at this point. Talk to the other guy and merge together. You might be able to cut down costs and become much bigger, much better. So that small fish in a large pond syndrome kind of a thing. So those are some of the things that I'll leave as a take home for small business owners to see whether you can do, or for big business owners. Policy.
Go ahead.
Policy, I think I probably it's a very large area, but one of the things from stemming from these discussions, if many are in difficulty, I wonder whether it will be a good thing for the authorities to look at some kind of distress management asset-based policy to ease out, so that you can run your operations without much of a burden. Already, I think there are these discussions. Some areas it has already taken place. Bankers would know and all that. But whether that is a possibility, because I think in any economy, this SME sector is very important. They kind of form the nucleus for the economy, if I may put it that way. So you need to kind of ensure that they are managed well, and they also kind of survive for the long term. So probably that's an area maybe we could look at.
Cool. Sharani, can I bring you in? What are those out of the box policy ideas? And if you were an SME, how do you get, what are your options in this climate?
Okay, let me start with the policy idea, and maybe I'll go out on a limb a little bit here. But I think one idea that could be interesting is a more structured or coherent framework a legal framework in which to work out some of these sort of financing and other challenges. And it would be also interesting to hear more of Nirmal's comments on this. But over the last couple of months in the US, we've seen a number of large companies and small file for Chapter 11. And what that allows them to do is to reemerge from that process in a much more sustainable form. So, I mean, a lot of the airlines is the most public example. They have all gone through, or many of them have gone through this, and they've actually emerged as stronger companies. So I think from an economic perspective, that really allows capital to be recycled through the economy. And I think that's a particularly interesting one for me from a restructuring perspective. I think other panelists covered more so the macro and policy impacts. So I would be really interested to hear what Myanmar thinks of this as well. uh, and actually, I can go on to in terms of ideas for businesses, I think Murali covered the first part, which is really like, look at your business in a holistic way. So I'm not going to repeat that, but maybe an additional idea to throw in there is that think creatively about the forms of financing that are available to you. So equity certainly is the one that a lot of people are talking about. It may or may not be something you can access, but there's also different kinds of non-bank financing that companies may be able to access now. I mean, in the past, what we've seen is that non-bank financing has been accessed primarily by banks and by finance companies. But with interest rates so low at this moment, we are seeing investor interest in looking outside of these two these two borrowers, so to say. So I think this is actually a really good opportunity for businesses to look at tapping other sorts of financing. And that could be in the form of securitizations, that could be in the form of commercial paper, and it could also be in the form of a relatively untested instrument here in Sri Lanka, which is these quasi-equity instruments. So looking at sort of convertibles or more creatively structured instruments. I think it's been quite challenging to get these to generate investor interest in these types of things over the last few years. But given the interest rate environment, we're seeing investors more and more willing to take a look at it. And if I was an SME, I would want to take advantage of that.
Namal, will bring you in, and Sharani mentioned that we don't have a structured process for bankruptcy. We don't have a bankruptcy law in Sri Lanka. You already alluded to, or you already mentioned about, despite the lack of that, what companies can do. How far does that go? Are there any other ideas? How far can a company go down the sort of Chapter 11 path in Sri Lanka in the existing framework?
Yes, so I think even though we don't have a Chapter 11, in today's framework, we have actually reached the Chapter 11, right? Because we had a 6-month moratorium on debt, right? So I by and large, I think no bank is going to take any enforcement action for, in my view, the next 6 months as well, because any asset sale is going to be at hugely distressed prices, and therefore they won't be able to recover even the amount of their loans or even a decent part of it. Now, I think the magnitude of the problem is seen by the fact that even though we see the Saubhagya figures and all that and disbursements which are made by banks, I think a disclosure which was made by one of the private banks in their quarterly was startling, namely that 40% of their loan book was covered up by the moratorium. Now, that is a huge figure, right? To basically even think that, okay, maybe 20% of those people would not have actually required the moratorium. Even assuming that, like even 20% of your total loan book being covered by the moratorium would mean that at the end of the moratorium, there's obviously going to be some significant amount of restructuring or some sort of thing which will need to be done. Now, one thing obviously is the fact that in terms of banking regulation, even though maybe 20 years ago there was no prohibition on investing in equity, as time has gone by, there are a lot of restrictions on investment in equity by banks. Now that may need to be relaxed, because I think if the bank has a choice between a write-off of 20% of your loan and maybe taking an equity chunk for 20% of your loan, I think maybe the latter would still have to be the preferred choice. And maybe entrepreneurs would also feel comfortable with banks being equity holders rather than any outsider, because banks presumably may not be wanting control. But maybe some things like that would necessarily need to be done, because this problem is on a magnitude which I don't think even private equity or alternative sources of finance are going to be able to handle or deal with.
Nandika, can I bring you in on that idea that Nayamal proposes? Obviously it's not covered by the current regulatory structure, but why not some equity versus writing it off?
I think out of the discussion, this is the most radical idea that Namal brought in. Others, whatever we said, very, very generic compared to what he said. Maybe put it into a maybe different context. I think there are certain countries where the bankers are sitting on some of the boards, including maybe sometimes retired ones as well, sometimes not retired but active ones. As I can remember, I think maybe Namal might have some kind of an idea, or maybe his knowledge in this area is absolutely better than any of us. Maybe one of the structure that we might have to look at is maybe Germany, where some of the bankers are sitting on most of the boards as well. And now, I'm not going to throw out any idea on that, but given the choice whether to write off or whether to sit on the board, but there again, you need to be a bit careful about how we are going to contribute, whether you are able to kind of keep the independence, whether you are maintaining right governance, all that is there. But I think we are pushing to certain end now, where we need to look at out of the box. What you said, this is not out of the box, but this is kind of a revolutionary kind of. So we need to look at some of these. But we need to have kind of a very good conversation about it, very good discussion about it. Then the bank, the conventional, the Basel kind of thinking, ring fencing, all that, whether those are relevant today, whether the pandemic has changed those, where the people are going into certain edges where there is no other way to get out of it. So we need to have a very good discussion about it. At least I'm glad that this kind of idea came through for us to have a discussion, rather than even myself kind of trying to book down in the same kind of solutions that we are talking about. So better to have some kind of discussion, Shamendra, before we kind of throw out whether we are okay with that or not. But at least this is kind of a very radical idea which came through. I think better to have a long discussion about it.
Okay. With that, I think we will go towards asking each of our panelists to present any final thoughts they had. Take a minute, if at all. I will start with Murali, but before Murali starts, several ideas have come through, and I think one idea that is not so radical, and this is something Sharani and the Asia Securities investment banking team had tried to do, is to survey businesses to get a better insight on where they are, and potentially an area where the chamber can also step in. If the chamber can establish a wide enough survey, both covering large businesses and SMEs, so that a good baseline is established, and then we can see how we can observe how the situation is evolving over the next 6 months or 1 year, that may prove immensely valuable for decision makers as information to inform those decisions. Certainly something that we can do, and then we have the more radical ideas like the ones that Nayamal has also proposed. Murali, can I bring you in your final thoughts? Anything you want to add in terms of wrapping up?
Thank you, Shamindra. Just to bring in a couple of points that we discussed today as a kind of a takeaway, if at all, say when you talk about restructuring, ideally you should look at the holistic view, so that your business is not restructured just for today, but it is a sustainable business. That is number one. Secondly, I think balance sheet is a reflection of your actions. So if you want to restructure balance sheet proper, then restructure your action and realign. That is when you will have a proper balance sheet restructuring. Thirdly, restructuring, in my opinion, is not for distressed companies, but as an ongoing mechanism of fine-tuning your business to be better into the future. So that's another thing that I think I would like to leave as a thought. And then finally, there'll be many methods of bringing in those required capital or debt or whatever, but external scan all that is needed. So wherever needed, get expert advice, so that you can be healthier today to fight tomorrow. So the idea should be to build a future-proof entity tomorrow. So with that thought, let me kind of thank you for bringing me to the panel.
Thanks, Murali. Sharini, can I ask you to go next?
Sure, although I think Murali did a really good job in summarizing the entire discussion. So, and I have to agree with most of his, or all of his points. I think the one thing that I would add to that is to use this moment as an opportunity. I mean, it's clear that there's a lot of financial and operational distress across the business sector, but this really is an opportunity, as Murali said, to rethink the business, rethink the balance sheet, rethink your even operating structure, and reposition it for future growth. So I think I'll just leave it at that.
Nandika, may I bring you in? Final thoughts? Anything to add?
I think, as Sharini mentioned, most of the things were kind of very much articulated and captured. Maybe one of the things for us to look at is, as I mentioned earlier, also to keep track of the changing circumstances. And there again, the current sentiment of the people and current situation. As you correctly said, Shamindra, you yourself mentioned it, and I just thought better to stress on that. The chambers and the ASEC and the agencies coming through and keeping a track of it and doing as much of research and coming out of it and having a kind of discussion is going to be extremely important time to time. Maybe within another 2 weeks, the situation can be fairly different. So that particular keep that thing rolling and keep we are talking about business sentiment, the closely linked to the cash flows. So keeping a real track of it and keeping a grip on that is going to be extremely important, and so frequently that should take place. I leave it that rather than try to kind of summarize, because it's already very well summarized, Shamindra. Thanks.
Thank you. And Nayamal, can I bring you in?
Yes, I think I would like to see a greater degree of cohesiveness amongst banks in dealing with SMEs or corporates. Right now, what has happened is banks are obviously competing, and to that extent, they consider that maybe a particular client is their client, notwithstanding the fact that those clients have also borrowed from other banks. Now, eventually, in this whole process, I think the people who have the financial knowledge and the expertise, right, need to be utilizing their skills to the greatest possible extent in order to assist the corporates and the SMEs very specially. So if by some chance, for example, there are 3 banks who have lent to an SME, right, we would really expect going forward, the 3 banks to get together and say, without waiting for the SME to come to them, the 3 banks need to come to get together and say, okay, there's 150 million of debt, right? And this company is not going to be able to make it. And we need to be able to push this agenda through with them, because if not, we will all come, or we'll all go down. So that sort of proactive action, I think, is required, or very especially over the next 6 months, in order to be able to assist the SMEs, at least in at least a viable path out of their financial difficulties.
Thank you, Nayamal, and I think for everybody on the call, it is for me to thank the panel. Thank you, Nayamal. Thank you, Sharini, Murali, and Nandika for joining this panel. I think this has been a very informative discussion. This is a webinar that was put together by Asia Securities Investment Bank and also in collaboration with the Ceylon Chamber of Commerce. So thank you everybody for joining us. If you do have any questions that were not taken up today, or you'd like to get in touch with one or any of the panelists because you have a specific question, please do write to the chamber to get in touch with the chamber. They may be able to help you with that. And thank you very much for taking a couple of an hour and a half of your time this morning to join this discussion. With that, we wrap it up. Thank you, everybody. Thank you all, Nayamal, Sharini, Murali, Nandika. Great having you.